Investors are revising the forecast for the next policy moves of the U.S. Central Bank in the light of the recent turmoil in the U.S. banking sector. Besides, the U.S. CPI, released on Tuesday, is another piece in the puzzle. The fresh evidence of a cooling inflation gives the Federal Reserve leverage to hit the pause button on a monetary tightening to avoid risks to the American financial system. In this context, the US dollar weakened across the board and slipped to one-month lows. Investors search for clues to intention of a major central banks literally in every macroeconomic report. It's not only about the Federal Reserve. For instance, market participants are alert to the employment change data for Australia, which will be on tap during the Asian-Pacific trade on Thursday. The report will determine further the Reserve Bank of Australia is resolute to go ahead with the rate hikes. Australia clearly needs measures against soaring consumer prices. The central bank has to raise interest rates to curb stubborn inflation. If the forecast of employment growth of 50,000 jobs comes true, the Reserve Bank of Australia will have an excuse to increase the interest rate by 25 basis points at a regular policy meeting. The market will certainly welcome such prospects. Obviously, the ECB is committed to its struggle against high inflation. The European regulator is widely expected to tighten its monetary policy and raise the repo rate to 3.50% at the meeting on Thursday. By contrast with the ECB, further policy moves of the US Central Bank are now unpredictable on the back of the simmering bank crisis. Hence, the ECB decision will strengthen the euro against the US dollar. To be honest, European financial markets are gradually getting infected by panic. Bank clients in Germany are rushing to withdraw their deposits. Investors want to hear comments from the ECB policymakers on the likelihood of a bank crisis in the Eurozone countries. For the time being, the ECB is likely to comment on its progress in the fight against high consumer prices. The regulator has nothing to boast about. Indeed, inflation is ebbing away at a modest pace. On a Friday, market participants will get to know the revised CPI for February. According to flash estimates, the annual CPI logged a downtick to 8.5% in February from 8.6% in January. Such a tepid dynamic appeals for higher interest rates and assures the central bank to proceed with the aggressive monetary tightening. This trading week, the Bank of Russia is also holding a policy meeting. Unlike major central banks, the Russian regulator can afford to maintain its status quo in a monetary policy. The key policy rate is expected to remain at 7.50%. As a result, the ruble will gain momentum to escape from the trading range and hit for a 74 against the US dollar. The market sentiment on the dollar-denominated assets will be shaped entirely by developments in the bank crisis. Speaking of the economic calendar for the rest of the week, the only report worthy of investors' attention is the survey by the University of Michigan on the consumer sentiment. Analysts foresee a minor dip in the index after the reading reached in February the highest level since January 2022. How will going to be in the short term in financial markets? We will definitely tell you in our next news releases. Don't miss them and stay up to date with us. See you soon!